Would you wear the same shoes for every occasion? Or rock the same outfit 7 days a week? Of course not. Your style is better with options. Your investments could be too. SIBO Index options give you access to various contract sizes, global trading hours, and potential tax advantages. That's a good look for any portfolio. If you're ready to invest in style, head to betterwithoptions.com. There are risks associated with SIBO company products. Review the disclosures and disclaimers at sibo.com/US_disclaimers.
Build your fit to the day with Abercrombie's newest denim drop. I'll tell you where to start. Abercrombie's 90s straight jean goes with any shirt from tees to sweater polos. Super versatile. Their loose and baggy jeans are more trend forward, so I grab those when I go out with friends. Right now, get 25% off on almost everything at Abercrombie. Offers valid in stores and online January 23rd, 2025 to January 28th, 2025. In U.S. and Canada, exclusions apply as indicated. Online price reflects discount.
Welcome back to The Bull, your personal finance podcast. We have mentioned him several times. We have dedicated 2 entire episodes to some of his most brilliant analysis. On many occasions, I've turned to him to better understand how to think about my portfolio and investments. He is undoubtedly one of the smartest people in the US financial landscape. He has managed to combine an impressive technical expertise with an unparalleled ability to communicate complex concepts so effectively that they almost feel like common sense. I can even begin to describe my excitement when I saw his "sure" in response to my long email, where I'd asked him to join the Bull. 1,000 words from me, 1 word from him. Less is more on steroids. Ladies and gentlemen, it is with great joy that today we bring you a wonderful conversation with the amazing Meb Faber. We cover practically everything from portfolio diversification to market prices and concentration, momentum and value, dividend investing, and how investing is a lot like cooking pasta. Something he knows well despite living in California, thanks to his wife who once lived in Bologna and knows exactly what it means to cook pasta properly. Without further ado, I'll leave you to my conversation with the great Meb Faber. Dear Meb, welcome to my podcast, The Bull.
Great to be here. Thanks for having me.
It's great to have you here. You are well known among my audience. In a lot of episodes, we talk about you, and it's amazing you accepted to come here in person.
We'll have to do it in the real world one of these days. You know, my wife speaks Italian. I'll bring her along. She used to live in Bologna. Yeah.
Wow.
I need to come ski in the Dolomites before the Olympics, you know. That's on my to-do list.
You do need to come here. So, we will be waiting for you.
Perfect.
Today's idea is to cover some topics that, in my opinion, should be the core of an investor's foundational playbook. And if you don't mind, let's start with diversification. 10 years ago, you wrote a great book on global asset allocation, which was a milestone to me. I reread 4 to 5 times every year, and it always tells me something new about how to think about my portfolio in an unbiased manner. So, I'd like to ask you a bunch of questions starting from here. Number 1 is very naive, but nonetheless crucial nowadays. Why should one diversify across different asset classes if a simple ETF on the S&P 500 returned an average 10% a year for the last 100 years or so?
You probably shouldn't, or shouldn't have, I should say, in retrospect. You know, the U.S. has certainly been a fantastic country to invest in. You know, you kind of have to flip that question, though, because, you know, if you and I were sitting in an Italian cafe or maybe some Western bar out here in California in 1899, you know, and we said, all right, let's predict which countries are really going to succeed, which ones will be, you know, the big winners and losers of the 20th century. I don't know how if we would have gotten the order right or even been able to pick, the top ones. And I think that kind of illustrates the uncertainty of investment. The U.S. has been an exceptional place to invest, and it's been particularly incredible the last 15 years. It's been a 10 bagger. So since 2009, which is awesome. But, diversification is the biggest key to all of this to me, is two things. One, you have to save your money in the first place. So you have to have some sort of income or savings in order to invest. And then you just got to get in the game, right? And then once you let the money start compounding, I'm actually writing a second edition to the Global Asset Allocation book. So you should hopefully see that soon, as well as a coffee table book called Time Billionaires, which hopefully will be out this year. But the concept is you just need to put the money to work. And in my mind, thinking about just if you're looking at just stocks in general, the global market portfolio of stocks. And so investing in all the countries around the world, to me, is a much more thoughtful way of going from a starting point. And there's probably over 50 investable countries out of the 200 or so countries in the world as far as equities. And you never know which one's going to be the best performer this year, this month, next year, next decade. But it certainly has been a pretty astonishing run. The biggest takeaway from this, we have an old post called the Case for Global Investing. And the U.S. is darn near 2/3 of the world's market cap now, if not 70%. Hasn't always been the case. Japan was a bigger market cap in the 1980s. But if you look at the drawdowns, it is universally better to have diversified globally. And you can do that market cap weight, you can do a GDP weight. As far as risk metrics, drawdowns, the U.S., people forget the Great Depression, U.S. stock market went down over 80%, an astonishing number.
In the 20s.
Yeah. And so it was really, really difficult. I don't know how many people on Twitter and elsewhere, they struggled a 10% drawdown. Forget about 20 or 50 or 80. Think about 80. That requires over a 300% gain just to get back to even. So diversification, you end up with a much more balanced and almost always a better portfolio that kind of eliminates a little bit of the jiggles at the periphery.
Have you ever heard the statement, "This time is different"?
I hear it all the time. And the challenge is investors love to extrapolate the most recent past into the indefinite future. And the example I was giving on Bloomberg this morning, I said, there's a Investors Intelligence Bulls Bears survey, and it's been around for I think 70 years now. And they ask investors in the U.S., are you bullish, bearish on the stock market? And you can look at the spread. And if you look at the top 10 most bearish years, so you look at the average across the entire year, the future stock market returns the next year historically have been 0. And if you look at the most pessimistic, so when everyone hates stocks, super bearish, the returns on average the next year are 20%. And we just...
So they are negatively correlated.
Right. So people were bad at, extrapolating, what just happened. In 2024 was, I think, the third highest on record. And usually you can pinpoint the years, be like, all right, I see where 2008 is, and then, of course, the next year was solid. So it's humans, we're our own worst enemy when it comes to emotions. I think that the single most bullish investors have ever been in the U.S. stock market in the AAII survey was December 1999, the single worst month in the entire history of the stock market as far as valuation, right? They got it exactly wrong. And the flip side of that story, of course, can't make it up, would be March 2009 when people were most bearish, the single best buying opportunity of the last 20 years.
As far as things that last forever are concerned, there is a question that I often ask my guests and always get different perspectives. The 60/40 portfolio, is a well-established benchmark for any retail investor. After 2022, it was declared dead. Interest rates increased, caused a disaster for both stocks and bonds. I guess it was one of the worst years on record for the 60/40 portfolio in the entire history. A lot of critics said it was that because we have had 40 years of steadily declining interest rates and negative correlation between stocks and bonds. And now this mechanism after 2022 is broken. What do you think about it? Should we start thinking differently about a common typical diversification pattern between stocks and bonds?
Yeah, my favorite investment book is Triumph of the Optimist, and it looks at a long history of stock markets. And listeners, you can find free versions of this online or go to your local library because it's an expensive book.
Great. Deemson, Marsh, and Staunton.
Yeah, and it looks at the long run of not just stocks, but also bonds and bills and inflation in all the countries in the world. And the challenge with looking at the historical record is it feels like a couple hundred years is a really long time, but really it's not that long. And so every day, every week, every month, we're always going through something where we say, this is the first time this has ever happened. So last year, for example, 2024 was the first time in history that US stocks and gold were both up 25% in a calendar year. Now, what that means, I have no idea. But my point is just like people always make assumptions, and one that I think a lot of professional investors made during this past cycle was that stocks and bonds are always inversely correlated and they always diversify. But if you studied history, and particularly the first half of the 20th century, you would know that that's not always the case. In fact, bonds often didn't hedge, and gold is another good example where gold sometimes helps, sometimes it doesn't. And so we always say, look, it's great to have lots of different assets that zig and zag on average, but you should never really expect them unless it's something like a puts on the stock market that by definition, is almost guaranteed to do well when stocks puke. Traditional assets, so global stocks, global bonds, global real assets, you can't make the assumption that they're going to diversify when things hit the fan. And sometimes they do, sometimes they don't. 2022, you can make broad generalizations, but 2022 was certainly one of those years that surprised a lot of investors because stocks and bonds is one of the worst years ever for a 60-40 portfolio because they both did very, very poorly.
But was it actually that surprising with interest rates that low for such a long time?
Right, because you're a student of history and you have a good head on you. But for other people, everyone loves to extrapolate their own life experience, right? If you talk to an investor in Greece or an investor in Japan, an investor in UK, an investor in the US, but not only by their birth year. So when did they experience various markets? And Vanguard has a great study in the US that looks at the year the account was funded and then how much they have in equities. And not surprisingly, you can see that depending on when people funded their accounts, they're much more likely to have a lot or very little because of their own experience. So if you experienced 2008 or 2009, which feels like a lifetime ago, plenty of young investors didn't go through that. They haven't really experienced, at least in the US, a bear market. But then you talk to investors in other countries, Argentina, on, China, and they have very, very different expectations and ways they think about markets. And I mean, if you look at some markets like China, the stock market hasn't gone anywhere for 30 plus years. Japan had one of those periods. Other countries, stock markets are still down 80% on a real basis from all-time highs. So people come to different conclusions based on their own lived experience.
Somewhere you talked about the Talmud as one of the first place where you can find a germinal theory of diversification, something that can be translated into the advice of diversify your wealth into the ancient equivalent of stocks, real estate, and bonds. Now, there's a lot of talk about alternative assets. You mentioned gold, of course. It's an everlasting asset in many portfolios. There's a lot of debate about private markets and crypto as well. I'd like to have your opinion about how to have a proper diversification in 2025.
So I like to think in terms of the global market portfolio, if you just bought every public capital asset in the world, is a pretty good starting point. Like that's the true John Bogle Vanguard market index. And it's also a great portfolio, and it's pretty hard to beat. And it's roughly half stocks and bonds and roughly half US, half ex-US. A little more US stocks now because they've gone up so much, and a little more foreign bonds. But the Talmud portfolio, I think the exact phrase was let every man invest a third in business, a third in land, and a third keep in reserve. And I interpret that as stocks, bonds, real assets. So when I say real assets, I mean things like real estate, tips, commodities, commodity-linked stocks. And so that's also a really hard portfolio to beat, because when you think of the main different regimes throughout history, you have growth and recessions or depressions. You have high or increasing interest rates, low declining interest rates, ditto with inflation, ditto with bull and bear markets. And so the goal is, how can I build a portfolio that sustains all of those and does okay in different types of regimes? Because the 1970s was a very different market environment than the 1990s and then the 2000s. And so I personally believe you need some in all three of those main categories, right? This is an Italian audience. Y'all love to cook. My family loves to cook. The example I usually give is, chocolate chip cookies, but we can talk about, I'd probably murder it with the pasta. But I'm saying it like with cookies, as long as you have the main ingredients, it doesn't matter exactly how much butter or chocolate chips you have, right? But if you totally forget flour or butter, they're going to end up awful. And so, like, maybe it doesn't matter if you salt the pasta water or not, that's a big debate. But if you exclude the sauce or the actual pasta, it's going to come out funky. And the same thing with markets. Like, could you go all in on stocks? You could. Could you go all in on real assets? Sure. But it's just not optimal or ideal in terms of being resilient. And being resilient meaning, like, you're gonna deal with these fat drawdowns at some point, and there's no way to avoid them, and particularly on an after inflation basis. But a portfolio that has all three of those, in my opinion, is the most robust. It doesn't have to be a third each. You could have 70% in stocks and then 20% in bonds and 10% in real assets. I don't think it really matters, but they'll jiggle at different periods, and at different periods, as you saw in like 2022, some assets really, make a big contribution when others sort of lag. So this whole market environment for the past 15 years, it's funny because Americans tell me, Meb, you're an idiot. I hear this all the time. You say to diversify globally, and that's a really stupid idea. I should have put all my money in US stocks. That's cost me money. And I say, well, hold on a second. Global diversification worked in 49 of 50 countries around the world. And that's mainly because every other country would have invested in US stocks, which has been the premier asset. It's only not worked in one country, but you can make that extension all around the world for every single 5 or 10 year period. So I think that having the main ingredients, people focus way too much on the exact amount, on the exact application. I think as long as you have the main ingredients, the cookies and pasta will turn out okay.
Great metaphor for an Italian audience. I remember a piece you wrote a year ago. I think the title was The Bear Market of Diversification. And you make a joke about people investing the right way in 2014 with a globally diversified portfolio, and the average John Doe who invested all of his money in the S&P 500, making tons of money. So, who was right? Who was wrong? How can we cope with that feeling for such a long time, especially when your neighbor did that better than you?
Yeah. So the name of the actual paper was The Bear Market and Diversification. And I wrote this at the beginning of 2024. So this always goes to show you need some humility in markets, but also a sense of humor, because after I wrote this paper, the stock market went up 25% last year. So this is a good example of timing. But the paper basically said since 2009, there's only been 4 periods where the US stock market in history has returned 15% a year for over a decade. And I said they all have names. It was the Roaring 20s, There was the Nifty 50 period, the mid-century, and then the internet bubble, which is what I kind of, cut my teeth on. And then whatever we're calling this, COVID, meme stonk, media, AI boom. But the good times are often followed by the not so good times: Great Depression, inflationary 70s, internet burst, .com burst, as well as global financial crisis, and whatever comes after this. Doesn't have to be a crash. It may just be lower returns for some period. But the point I was trying to make is, I said, if you diversified anything other than U.S. stocks as an American, it hurt your returns. Of course, that's the way math works. But what's unique about this is the number of years in a row. So we're talking 14 out of 15 years, 15 out of 16 years in a row where the S&P outperformed any diversified portfolio, 60-40, global market, endowment style, and then magnitude. And so there's really only been 3 periods like this. The 90s was one, the 1940s, so post-World War II was a big one, and then now. And they don't last forever. And in terms of magnitude, you've underperformed by hundreds and hundreds of percentage points, which is an astonishing amount. But we would argue that's the wrong benchmark, right? Like, investing 100% of your money in one country is extremely dangerous, as we've seen throughout history, throughout time. And so it doesn't mean it can't go higher. We haven't talked about this today, but half of my brain is trend following. And so that side of the sort of methodology kind of keeps you invested as long as the party's still going on. And the party's still going on, all sorts of craziness happening. But on average, you want to make sure the whole takeaway of all of investing is it's like gambling or playing blackjack or poker. Like, you can't get taken out of the game. You lose all your chips, you can't play. And so the problem for a lot of investors is the big drawdowns. And so the struggles, if you do sit through the down times, they're really hard, not just financially, but also psychologically and emotionally too.
Yeah. Talking about trend following, you offer me an assist for the next topic. In the 60s, if I don't get wrong, William Sharp talked for the first time about beta, and in the 90s, Eugene Fama and Ken French came up with the 3-factor model. Since then, we all know that the excess return in the stock market can be explained by several factors. 3 factors, 5 factors, 6, 100, a factor zoo, as Cochrane famously said. I have 2 questions about factor investing. Eugene Fama was here in this podcast and I asked him about the momentum effect. He doesn't like the momentum effect, we all know it. He said it's not convenient and he doesn't see evidence of its effectiveness. He said it's not convenient because it takes a lot of money for taxes and transaction costs due to the high turnover a momentum tilted portfolio requires. What do you think about the momentum effect? Do you think it's a compelling idea for tilting your portfolio?
So you want to get kind of deep and philosophical here. Should probably have a glass or 2 of Chianti. Yeah. We think that if you think about what a market cap index is, so talk about Fama, efficient market, John Bogle, the true market cap index, it's only a price-based index. So if the price of a stock goes up, you own more. And if the price of the stock goes down, you own less. I mean, you could argue, and I think it's hard to argue against this, that is a trend following system. There's no fundamental inputs. Doesn't matter if the company, how much revenue it has, even if it has revenue, it's just simply what the market is willing to pay, price of the stock times the shares outstanding. Now, that's a fantastic way to invest because you're guaranteed to own the winners. And if we know anything about investing, is that it's driven by power laws, meaning the big winners determine all your gains. So if you buy the whole market, guess what? You can go to happy hour, you can go to the local cafe and brag to all your friends that you own NVIDIA, that you own Novo, you own Apple, you own all these amazing stocks. Now, you own all the losers too, but it's usually about 10% of the stocks out there deliver all the return. And so an index, which is just sort of a naive trend following approach, guarantees that you're going to be invested in the good ones and own less and less fewer of the declining stocks. Now, you can take that to its next logical extreme and say, well, maybe I can apply that theory methodology to my portfolio as a whole, to various assets, to where I can say, you know what, I don't want to own stocks at all because the large asset class might be declining, the same way I would think about it on a stock by stock level. Now, it's like a painter. There's 1,000 different ways to implement this, but on average, what it helps you do is exit as markets are declining. So to avoid the big, what we call the haymaker losses, like it's not going to matter if you're going to avoid the 5-10%ers, but these like 40, 60, 80% losses. Some people even do shorting, but the whole kind of driver of the returns is you want to make sure that you're invested in as many different investments as possible. So us quants like to call that breadth, right? You have as many choices as possible. And because you never know where the return is going to come from. Is it going to be cocoa or the Japanese yen or Nvidia or oil, on and on? And so trend following, I think is a similar theory of indexing, just applied to a broader landscape with some different metrics. And personally, I think buy and hold is fantastic. We manage lots of buy and hold portfolios, but as a hedge to a traditional buy and hold portfolio, I think there's nothing better than trend. Momentum and trend are kind of like first cousins. They're similar, but not quite the same thing. But it's up there with me with value as a methodology that is a cornerstone of kind of what we do.
I talk about momentum because in Europe we have some constraints about the products you can invest in, and products like managed futures are not widely available for retail investors. So momentum is the closest relative to that idea. When it comes to a factor that is less correlated to momentum, which is the value factor, the value effect seems to have disappeared in the last 20 years. Fama told us that once they published the paper with French, people started to pile in, and then the effect disappeared. Actually, I think that in the early 2000s, value stocks kept beating growth stocks for a while. But now we are witnessing a very long time of growth stocks outperforming value stocks. The question is, has something fundamentally changed about it? Or can we say that there's going to be a reversion of the mean sooner or later?
Anytime you measure something at what potentially is a local or kind of regime maximum or minimum, it feels pretty extreme. So if you look at valuation on the US stock market, in my opinion, there's no question it's broadly expensive and on par or similar to many of the measures from the 1990s. Now, the beautiful thing about the stock market is it's not just one choice, right? So you go to the wine store, there's hundreds of bottles you can choose from. You don't have to just get the table wine, right? So same thing with the stock market. There's thousands of stocks, and many of which trade at totally reasonable valuations, have great cash flow, great management, on and on. But there is a subset that are extremely expensive. And on average, throughout history, that's been a pretty dumb way to invest if you buy something that trades at 100 times revenue. Now, maybe we're all assimilating into the matrix and AI is going to take over in 2 years. None of this is going to matter anyway. But on average, paying up throughout history is a recipe for very poor returns with a lot of volatility. And, you read a lot of history of the various markets and euphorias and manias that people get excited about. It could be railroads, it could be plastic, microprocessors, internets, on and on. There's hundreds of them, and people usually extrapolate into the far future. So measuring something like value today, where there's my European friends at Robeco put out some great charts where they look at the value spread. So cheap minus versus the expensive. And it shows that this is one of the best opportunities that they've measured for buying value style stocks relative to expensive ones. But the beauty of financial markets is these types of measures and spreads can always get worse, right? They can get even more extreme. So we talk about Japan and we say, look, the US stock market's expensive. It's bordering on a bubble for us. But you know what? To get to the valuation where Japan was in the 80s, it would have to double from here. Can you imagine? I mean, my goodness. And so, there's no question that we believe that the broad market is going to have subpar returns going forward, but it's always a matter of timing, and it could always get worse or better depending on your perspective. So measuring things like value at this particular moment in time, I think, is problematic. But I always go back. All of this comes to me under the banner of common sense, right? Is there a world where finance makes sense to buy stocks that are trading at totally insane valuations? Like, that just doesn't make any common sense to me. You have to incorporate growth, okay, right? Like, growth matters, absolutely. But looking at both sides of the coin, everything would break if somehow valuation didn't matter anymore. And usually you have a nice bear market to come clean that sort of stuff out. But we haven't really had one here in some time, but plenty of places around the world certainly have.
How can one say that high valuations become overvaluations? Because if we take standard metrics like the Shiller-Cape ratio, we are 3 standard deviations from the mean now, at the 97th percentile. And by any historical standard, the market is very highly priced. The index composition of the S&P 500 is very different now than it was in the 60s, in the 70s, in the 80s. We don't have now huge railroad, chemicals, manufacturing companies with great capex. We have mostly tech and service-related companies. They are expected to grow at a higher rate, to have a ton of cash, and to deliver great return on equity. So the question is, how much do valuations matter when it comes to deciding how to allocate money for my long-term portfolio, granted that what happened in the past could be a poor guide for future decisions?
One of my favorite papers by Schiller was a paper about the 1920s, so the Roaring 20s, 100 years ago, and it was looking at the two hot sectors of the day, utilities and railroads, and there's total bubble in those markets, and they went up to a Cape ratio. I think it was like 50 or 60. So that was the tech of the day, right? So if people can get hot and bothered about railroads, you can get hot and bothered about anything, right? So I think if you look at there's a great little piece Cliff Asness put out recently where he did a humorous retrospective from 2035. So
I made an entire episode about it. It was remarkable.
Oh, good. So you guys got into Fartcoin already.
Just 10%.
I mean,
just 10%.
Yeah. So, it wasn't that long ago, and I can remember sitting around in 2007, and everything in the entire world had outperformed U.S. stocks, right? Ex-U.S. markets, foreign markets outperform U.S. stocks, bonds, real estate, commodities, gold, REITs, everything had beaten U.S. stocks. People were giving up on them. These things have a way of rotating and taking different places. It's just they last a lot longer than any of us want them to. So as humans, we want certainty, and in an age of TikTok, which I don't know, might get banned soon, so who knows here, but in an age of these short form, hyper focused attention spans, people want the certainty, but in reality, these things play out over often decades, which can be lifetimes. Like a great example I gave, I said, the number one universally held belief in at least for Americans on investing markets is that stocks outperform bonds. Stocks are the premier asset. They beat everything. You just got to buy and hold stocks for the long run. I love Professor Siegel, but that concept, right? And we'll often ask people, well, like, how long should you be able to give stocks versus bonds to realize that sort of premium? And most people are like 5 years, maybe 10. And there was a point in 2022, I think, or during COVID, 2020 probably, where stocks had underperformed the long bond in the US for 40 years, right? 40, so that's 4 decades. That's many careers for most of us. And so, these sort of regimes can play out over much, much longer periods than I think people are willing to accept, or want to accept is the better way to say it.
One of the main source of concern today seems to be the high concentration of the US stock market. For example, Dave Costin from Goldman Sachs cited market concentration as the main reason behind their outlook, forecasting that the S&P 500 will deliver an average compounded annual growth rate of 3% over the next decade, which made headlines when they released it. On the other hand, I remember when you interviewed Hendrik Bessembinder, he wrote great papers on the fact that a very small number of stocks made all the difference throughout history. If I remember correctly, in his latest paper, he found that the top 2.5% of the highest performing stocks accounted for 100% of the excess return over the past 3 decades. So, how can we reconcile the idea that a highly concentrated market could be a problem with the fact that only few stocks deliver all the returns?
Historically speaking, the Achilles heel, the weakness of a market cap index, is because it has no tether to valuation or fundamentals. The stocks that end up the biggest weight are the ones that have gone up the most, right? That's very simple to prove. And the problem with that is usually the ones that go up the most get to the highest valuations, or said differently, the ones that go down usually are trading cheaply. So throughout history, almost any weighting methodology outperforms the market cap weight because you break that market cap link. And so you could do equal weight, you could do based on fundamentals, you could do value investing. It really doesn't matter throughout history. And there's lots of charts. One of my favorites used to be, what if you just invested in the biggest stock in the stock market when it was the biggest versus the S&P? And it's a horrible way to invest. And there's a very simple methodology to outperform the S&P by like 0.5%, is you just exclude the top 10 or how many ever of the top stocks. Now, the problem with this, and what makes markets so much fun and also infuriating, is that that strategy of investing in the biggest underperforms, over time, ditto for the most expensive. But every once in a while, it'll do a face ripper just straight up, right? Where you'll get something like an NVIDIA and it'll go straight up, cause pain, angst, career risk for all sorts of people. And then it'll crash right back down and continue on its merry way of doing poorly on average. And that's true with markets in general, right? Like you have these times where things go bananas and it's in both directions too. So if you think about markets, we did some really old studies in my very first book, where we looked at markets that were down many years in a row, but also that were down 60, 80, 90%, and found that if you close your eyes, hold your nose, usually is a great time to be buying some of these hated, forgotten, totally abandoned type of industries, countries, sectors, stocks on average. And so I think that the same is true on the opposite side, from the euphoria and from the giant size. Rob Arnott had a really fun paper last year that profiles index deletions and how they perform relative to the additions. And he's got a fund called Next. And I forget what the exact name of the paper is, but it's a really interesting concept where, they get kicked out, and usually the stuff that's getting kicked out outperforms what they're adding. So it's sort of an orphan type of strategy, but one that to me makes a lot of sense.
Yes, totally. In 2024, you published the second edition of another great book, which is Shareholder Yield. It's very relevant for an Italian audience to talk about dividend and shareholder yield and the difference between the two, because in general, the European stock market is made of companies with a high dividend yield. And here in Italy, people tend to invest mostly in companies that pay high dividends because they pay high dividends, ignoring the difference between yield and return. I always say that in Italy, unfortunately, we have the same word to say both yield and return. And I think this is a main source of confusion about the two. So the question is, what do people get wrong about dividends?
Well, they get a lot wrong, and when we talk about a lot of topics, I think there's this pile of things that are totally fine. You want to invest based on a dividend strategy, that's totally fine. It's not ideal. There's lots of behavioral and psychological reasons to like dividends, but there's a whole pile of stuff over here on the left that's absolutely atrocious, terrible, awful, no good, that are way worse, ideas and things to be doing. And a lot of that usually applies to really high fees and really harebrained, terrible, no good strategies. I wouldn't put dividends in that bucket. But what are dividends? I think a lot of people get this wrong. If you ask the average investor, they think they're getting paid, a magical check or income, and it's really just a return of capital.
For their pina coladas.
Yeah, for the pina coladas. So, I think that the challenge that dividends historically, if you go back to the 1800s, investors didn't invest in stocks for capital gains. They invested for the dividends. So mentally, they were comparing them almost to fixed income or bond-like investments, right? The comparison was bond yield versus stocks dividend yield. And I think that has changed, where people accept this concept of capital appreciation, total return, as opposed to just dividends. And dividends, look, historically, dividends correlate, or we would say are co-inherited with other traits. So dividends historically are companies that have the cash to pay dividends. So usually, to have the cash to pay dividends, you've either built up a giant cash balance or your company's very profitable and you simply got a bunch of cash each year that you don't have a better use for. This is like finance 101, right? It's like, where's the best return on investment? Now, that often can also mean that you have companies that are old or companies that are declining in their relevance to the market. So they may not be interesting companies to own because their businesses are doing poorly and it's in a declining industry. Dividends on average do, if you have high dividend strategies, end up giving you a value tilt in markets and stocks because usually they've been beaten down or the price has gone down, thus the dividend yield goes up. And so you have cheap value stocks. Now, often they're higher leverage, so lower quality, junkier companies. But on average, it's a reasonable way to invest. One of the problems, though, is you have to pay taxes as you go, usually, if you're a taxable investor, on those dividends each year. And so we always love to point to Warren Buffett. Buffett gets it. He's been manning the helm at Berkshire longer than any other CEO in the U.S. and also hasn't paid any dividends, right? He doesn't want to get taxed on the dividends in Berkshire, and he thinks he can use that money at better purposes, whether it's buying private companies, buying other stocks, reinvesting in the business, et cetera. So I think it's there's been a big shift also in the United States, which is spreading around the world over the past 30 years, which is CEOs also understanding that the concept of share buybacks and share issuance. And so share buybacks being one that is more tax efficient or flexible dividend, if we could call them that. Our shareholder yield book, which you referenced, listeners, you can go download a free copy online at either shareholderyield.com or my blog. But it's a holistic view of how to think about stocks and capital allocation, incorporating, because any given year now, companies in the U.S. pay out more through stock buybacks than they do in cash dividends, which is material.
I think it's difficult to grasp the idea that dividends and buybacks, beside the tax effects, are conceptually the same thing. I think that the typical investor doesn't get it because she sees the cash in the account when dividends are distributed, while with buybacks, nothing seems to happen. It's a sort of cash bias.
I think also a fair amount of investors also don't realize the stock value goes down by the amount of dividend you just paid out, right? So, the buyback is, we often refer to as a hidden dividend. And, a lot of traditional finance websites don't report something like buyback yield, but it's also crucial to incorporate share issuance too, because if you're a company like the ones in my home state of California that love to pay out a lot of stock-based compensation to their executives, well, that's a huge dilution too. So you got to balance the two and incorporate it on a net basis. The best way to look at it is if you look at a stock on any of these websites and simply look at the change in shares outstanding over the past year. And like Charlie Munger used to say, you want to look for the cannibals, the companies eating themselves. So where the share count's going down, the one benefit, in addition to the tax efficiency of a buyback, is if a stock is trading below intrinsic value, then you're getting a value arbitrage there. So if a stock's trading at 50 cents on the dollar and the CEO is buying back shares hands over fist, you're getting $1 for 50 cents. That's an incredible trade, right? So I think a lot of, now the flip side is also true. If you're an expensive stock and the CEO is just a megalomaniac and thinks they got to buy back stock all the time because it's always cheap, well, then you're destroying value as well. So I think, we always tell people don't buy expensive stocks, right? You know, it's like you want to be in the cheap ones, and then the companies that are thoughtful about their capital expenditures.
Yes, unless you are Warren Buffett or the late Charlie Munger, it's difficult to assess if the company is cheap or not.
Yeah, I think you could come up with some pretty. There's some quant studies we included in the book where we said, let's ignore whether they think their stocks are cheap or not. And O'Shaughnessy did this, where they said, let's look at companies that did share issuance, the buybacks, and then the giant buybacks, and where did they trade in our valuation universe throughout time. And it's pretty awesome to see. But the companies doing share issuance, on average, were trading at high valuations, and the companies doing buybacks at low valuations, the ones doing the really big ones at the really big discount in valuation. So on average, the CEOs are no dummies. That doesn't mean your CEO is not a total moron, right? But on average, buying back stock and paying out dividends also, and this is what so many politicians get wrong, it also keeps the CEOs from spending it on totally insane things too, like naming stadiums or buying soccer teams or expensive dinners and jets, all that sort of destructive value, which, to be clear, if you just gave them more cash and said you can't return this, you got to do something with it, what are a lot going to do? Well, they're gonna live the life. They're gonna live it up.
Meb, we have covered a lot of topics. Thank you so much. I wish to leave you with a semi-serious question. We only have 3 times in history of the S&P 500 with 2 years back-to-back delivering more than 25% each year, in the 30s, in the 50s, and in the 90s. Is 2025 going to be more like 1997 or 1937?
Well, those were fun years. 97 was great, man. 98 was great. 99 was great. It was the problem that what came after that. Same in the 20s. The entire 20s was amazing. One of the challenges we often say people, look at the roaring 20s or look at other decades and whether this was a starting like a secular bull market and, the valuation. So 2009, yeah, the valuations were cheap. US was low teens on the CAPE ratio and no one was interested, no one buying. But that's not where we are today. We're high 30s. And so if you look at, kind of those metrics, and it doesn't even have to be the long-term PE ratio. You can use any valuation metric, doesn't matter. But on average, this looks like the end of the road rather than the beginning. So, enjoy the champagne, enjoy the party, the punch bowl, while you're there. Just, you have to have a exit plan or something to diversify it as well.
So we hope it's going to be like 1997 and not 1999, because then it ended badly for a very long time.
But it depends on your perspective, though. The challenge is like people always are fearful and don't want the bear markets, but that's what cleans out the system. It shows the bad actors. It takes out the companies that are poor allocators of capital and, maybe not sustainable. And so it's a feature, not a bug, is what I would say. Now, look, the bubbles are fun. I've lived through the 90s. I loved it. But at some point, the bear market, some of the greatest companies in the world were started during, bear markets. If you look at Google and Uber and other types of companies, you need some of that discipline and innovation and stressful times too.
Yeah, from a rational standpoint, it all makes sense. We should welcome bear market to buy cheaper stocks and deliver great returns in the future. The behavioral side is totally another story.
Said if you're a young person, you're cheering for a big, massive down, drawdown, because you don't want to be buying stocks up here. You'd much rather be buying them, at much lower level. If I'm a young person, I'm not buying. You forget these market cap U.S. stocks. I'm looking at foreign. I'm looking at emerging. I'm looking at value. We used to say this we go on TV or on Twitter, and there would be like a really big market day or a big market year. And we said the market was up 25% this year. Terrible year for young investors, or vice versa. The market was down 5% today. Great day for young investors, right? It's all about your perspective. If you're old, God bless. You just want this thing to keep going to the moon. But if you're younger, you don't. You would much rather want something cyclical and secular starting bull market.
Yeah. The sequence of return risk is something that's often overlooked in the accumulation phase, but we're all wired to think that when things go up, everything's fine, and the other way around. But obviously, I'm totally with you. Meb, thank you so much. It has been a remarkable episode with you, and thanks for accepting my invitation.
Had a blast. We'll see you guys in the real world, hopefully in Italy. Ciao.
We'll wait for you. Bye-bye.
Bye.
And that's all, folks. I hope you enjoyed this episode at least half as much as I did, but most importantly, I hope it provided you with valuable insights to become better investors. In the description, you'll find a link to Meb's website and his spectacular podcast and YouTube channel, The Meb Faber Show, where literally all the biggest names in finance you can imagine have been featured. If Meb listens to this episode, I'd like to thank him once again for his kind participation. And of course, I want to thank all of you for being here with me today for the episode number 180 of this podcast. Once again, I invite you to hit follow and turn on notification on Spotify, Apple Podcasts, or wherever you listen, and to leave a 5-star review to support us and allow us to continue producing content with extraordinary guests who can combine quant investing, surfing, skiing, and chocolate chips recipes always new. That's really all for this episode, and I'll see you next Wednesday all together, right here, of course, with The Bull, your personal finance podcast.